Welcome. Today we're diving into the fascinating world of long-run market dynamics. Have you ever wondered why in the long run firms in competitive markets tend to earn zero economic profit? It all comes down to the mechanics of free entry and exit. In this video we'll break down these concepts, explore how they shape industries, and see why zero economic profit is not as bad as it sounds. Let's start by understanding what we mean by the long run in economics and why it matters for businesses and consumers alike. Economics, the long run is a period where all inputs can be varied, and firms have enough time to enter or exit the market. Unlike the short run where some factors are fixed, the long run allows for complete flexibility. This means businesses can adjust their scale of operations, adopt new technologies, or even leave the industry if profits aren't attractive. This flexibility is key to understanding how markets adjust and why profits tend to normalize over time. Let's see how this plays out in real-world markets. Appreciate long-run dynamics. It's helpful to contrast them with the short run. In the short run, some resources are fixed, and firms can make profits or losses. However, these profits attract new firms while losses push them out. Over time, as firms adjust their operations and new players enter or exit, the market moves toward a new equilibrium. This transition from the short run to the long run is crucial for understanding how competitive markets function. Defining feature of competitive markets is the freedom for firms to enter or exit without significant barriers. If existing firms are making economic profits, new firms are drawn in by the opportunity. Conversely, if firms are suffering losses, some will exit, reducing supply. This ongoing process of entry and exit is what drives the market towards zero economic profit in the long run. Let's look at how this mechanism works in practice. Economic profit is not the same as accounting profit. It takes into account both explicit costs like wages and materials and implicit costs such as the opportunity cost of capital. When we say firms earn zero economic profit in the long run, it means they're covering all their costs, including what they could have earned elsewhere. This doesn't mean they're not making money. It means they're earning just enough to keep resources in their current use. Incentives play a huge role in market dynamics. When firms see others making profits, they're motivated to enter the market. This increases supply, which puts downward pressure on prices and profits. On the other hand, if firms are losing money, some will leave, reducing supply and allowing prices and profits to recover. This constant adjustment keeps the market balanced over time. As firms enter and exit, the market moves toward equilibrium. In this state, no firm has an incentive to enter or leave because all are earning zero economic profit. Prices settle at a level where firms cover all their costs, including opportunity costs. This equilibrium is a hallmark of perfectly competitive markets and ensures resources are allocated efficiently. For this zero-profit outcome to hold, certain assumptions must be met. Markets must be perfectly competitive, meaning many buyers and sellers, identical products, and no barriers to entry or exit. While real-world markets may not always fit this model perfectly, it provides a useful benchmark for understanding how competition shapes outcomes over time. When new firms enter a profitable market, they increase the total supply of goods or services. This greater supply puts downward pressure on prices, which in turn reduces profits for all firms. As profits shrink, the incentive for new firms to enter diminishes and the market moves closer to zero economic profit. On the flip side, when firms exit a market due to losses, the total supply decreases. With fewer goods or services available, prices begin to rise. This helps restore profits for the remaining firms, making the market more attractive again. This push and pull ensures that in the long run, profits stabilize at zero economic profit. Zero economic profit doesn't mean firms are failing. Instead, it means they're earning just enough to cover all costs, including the opportunity cost of capital and labor. This is a sustainable outcome, as resources are being used efficiently and firms have no incentive to leave or enter the market. It's important to distinguish between accounting profit and economic profit. Accounting profit is what's left after subtracting explicit costs from revenue. Economic profit goes further, subtracting both explicit and implicit costs. In the long run, firms in competitive markets earn zero economic profit but may still report positive accounting profits. Let's consider some real-world examples. Think about local coffee shops or small retail stores. When profits are high, new shops open, increasing competition and driving profits down. If profits fall too low, some shops close, reducing competition and allowing profits to recover. This cycle keeps the market balanced over time. Not all markets are perfectly competitive. Sometimes barriers to entry like high startup costs, regulations, or patents can prevent new firms from entering. When barriers exist, firms may earn positive economic profits even in the long run. Understanding these barriers helps explain why some industries are more profitable than others. In contrast to competitive markets, monopolies can restrict entry and maintain positive economic profits over time. This is because they control the market and can set prices above costs. The absence of free entry is what allows monopolies to persist and earn higher profits than competitive firms. The process of reaching zero economic profit is dynamic. It doesn't happen overnight. Firms constantly monitor market conditions, adjust their strategies, and respond to changes in demand and supply. This ongoing adjustment is what keeps markets efficient and responsive to consumer needs. Consumers benefit from the long-run dynamics of free entry and exit. Increased competition leads to lower prices, better quality, and more choices. When firms can't earn excess profits, they must focus on efficiency and customer satisfaction to survive. This creates a win-win situation for buyers. From the producer's perspective, zero economic profit means they're earning just enough to justify staying in business. They're covering all costs, including their own time and investment. If profits fall below this level, they'll consider exiting the market and seeking better opportunities elsewhere. Zero economic profit ensures that resources are allocated efficiently. Firms that can't cover their costs will exit, freeing up resources for more productive uses. This process helps the economy grow and adapt to changing consumer preferences and technological advances. The long-run supply curve in a perfectly competitive market is typically flat, reflecting constant costs. As firms enter or exit, the market price remains stable at the level where firms earn zero economic profit. This ensures a steady supply of goods and services at the lowest possible cost. Technological advancements can disrupt the long-run equilibrium. When new technologies lower costs or improve productivity, early adopters may earn positive economic profits. However, as the technology spreads, competition increases and profits return to zero in the long run. Innovation is a key driver of market dynamics. Firms that innovate can temporarily earn above normal profits, but as others catch up, these profits are competed away. This cycle encourages continuous improvement and benefits consumers with better products and services. Government policies can influence entry and exit. Regulations, taxes, or subsidies can create barriers or incentives that affect market dynamics. Understanding these impacts is important for predicting how markets will evolve and whether zero economic profit will be achieved. Industries go through life cycles: introduction, growth, maturity, and decline. In the growth phase, profits may be high, attracting new entrants. As the industry matures, competition increases and profits fall to zero. Understanding this cycle helps explain why profits fluctuate over time. Let's visualize entry and exit in action. Imagine a new trend in the food industry, say gourmet donuts. Early shops make high profits, attracting new entrants. As more shops open, competition rises, prices fall, and profits shrink. Eventually, only the most efficient shops remain, earning zero economic profit. Unexpected events like economic downturns or supply disruptions can temporarily upset the long-run equilibrium. Firms may earn losses or windfall profits, but over time, entry and exit restore balance. This resilience is a strength of competitive markets. Expectations about future profits influence firm decisions. If firms expect profits to rise, they may enter the market even before profits materialize. If they expect losses, they may exit early. These expectations can speed up or slow down the adjustment to zero economic profit. Zero economic profit in the long run is a sign of efficiency. Resources are being used where they're most valued and consumers enjoy the benefits of competition. This outcome maximizes overall welfare and keeps the economy healthy and dynamic. While the zero-profit outcome is a useful benchmark, real markets are often more complex. Imperfect information, product differentiation, and barriers to entry can all affect outcomes. Still, the basic principles of entry, exit, and profit normalization provide valuable insights into market behavior. Wrap up: the long-run dynamics of free entry and exit ensure that firms in competitive markets earn zero economic profit. This process leads to efficient resource allocation, benefits consumers, and keeps markets healthy. While real-world markets may not always fit the model perfectly, understanding these dynamics helps us make sense of how industries evolve and why competition matters.